For more on the corporate buyback spree and the overall markets, let's bring in Julian Emanuel, Senior Managing Director at Evercore ISI. Julian, great to have you with us. I would imagine that you are not against buybacks in the line of business but of course we do see companies that do use it for other reasons other than just merely capital allocation. We see value in our stock. It is used as sort of a accounting, trick.
There are lots of nuances, okay? But we have to understand one thing, that over the course of the last 20 or 30 years, and frankly going back further, shareholders like having cash return, whether it comes in the form of buybacks or it comes in the form of dividends, and buybacks have been one of these mechanisms. Now, the difference is that you're now in an environment where there's an actual cost to money for the first time in many, many years. So you're not likely to see companies borrow to increase their buybacks, which that's a good thing. But on the other hand, we're not fans of legislating what you should and shouldn't do. Let the market do that.
Yep. Here to that. Let's get to your view on the markets at this point. I'm not sure, based on the notes, where exactly you stand. Bearish positioning is neutralized, but you see some of the challenges getting higher and higher for the markets.
So it's an incredibly complex environment. We've said very recently that if you're not confused, you're probably not paying attention. And that is how the market is trading, back and forth between 3,800 and 4,200. From our point of view, this whole idea, however, that you've gone from despair in December when we saw this massive tax loss liquidation to all of those stocks being the leaders in the market, neither narrative is correct, but ultimately the odds of recession, given the collapse in money supply, given the rollover in leading economic indicators, and given, the 800-pound gorilla in the room, the yield curve, tell us that we're going to have a recession at some point. And so, therefore, we see a retest of the October lows at mid-year.
Not before it. And that's the point, right? Like, stocks can't retest until you have a recession or until you've begun to price that in.
Well, the fact of the matter is, going back to 1962, you have never had a bear market bottom before the start of the recession. And Ed Hyman's view is that we're going to have a short and shallow recession. And I think part of the narrative in January is we got very happy that the inflation data was calm for that time, and that got people to believe more in the soft landing scenario. But now here we are, and the Fed's going to just keep on going until something either softens or invariably, as it has through most of history, breaks.
Julian, as we wrap up earnings season and we start getting a lot more, or I would seemingly more focus on economic data, how do you think that translates into market activity, trading activity, investing activity?
So that is actually another one of the challenges. First, we have to step back and say this has been the first earnings season of the last three where investors were not able to completely shrug off the fact that estimates came in, that earnings season was, you had year-on-year declines in EPS for the first time since 2020. And, unlike October and July earnings seasons, you didn't have the index rally. So it's very much a stock selection environment. And actually, the vacuum of news between now and the unemployment report on the 10th, how stocks trade and how yields trade. We think the yields have gone a little bit too far here, perhaps in the near term. Let's see how stocks trade if yields pull back. If stocks don't respond positively to that, as they have for the vast majority of the last year, that'll be new information that perhaps we're a little bit more concerned about the slowdown.
Last quick question, Julian, and that is your call for a retest of the October lows is mid-year this year. That roughly coincides with where a lot of people see the peak Fed funds rate, and I'm wondering if that is a coincidence or if that's exactly why.
No, it's no coincidence at all. And I think the biggest debate among both investors and, frankly, the Fed is how monetary policy works with the lag. There's a school of thought that says it's only 6 to 9 months now. Well, we'd actually say it's probably more like 24 months because the stimulus was so huge in 20 and 21 that it's just starting to wear off now. And so you get to the second half of the year, and the hiking that started in March is just going to start to kick in.
That's interesting. Julian, thank you. Good to see you. Julian
Thank
Emanuel. Guy Adami, I saw you nodding in agreement with Julian when it comes to the lasting impact of the stimulus, and so therefore the lag effect is going to be even greater this time. That's interesting.
Yeah, and if you're not confused, you're not paying attention. I dig Julian, as you know, and I think he's exactly right. I think I think market participants are underestimating the lag effect, the impact that this Listen, I mean, it's historic what's going on over the last 13 or 14 months, and they see, no sign of waning. I mean, they're steadfast in their desire to quell inflation, and quite frankly, it appears as though inflation is about to rear its ugly head again. So for whatever reason, the market doesn't want to seem to acknowledge it. Recently, yes, but not nearly to the extent that it should. And again, if you're looking at $200, $210 worth of earnings, a 16, 17 multiple, I mean, you can do that math, Mel. We're looking at S&P that, in my opinion, should be 3,400.
And I think we're at an 18 multiple, Guy. And I think if you think about where we've gone from November, or certainly those October 13th lows, and we talk about this all the time, semis up 42%. I would emphasize what Julian said is I don't think stocks have begun to really price in this divergence between the bond market. We've had 60 basis points since that last payroll number. We have a payroll number next Friday. I think that actually sets the market up for possibly a place to rally a little bit because, again, bond yields have had such a massive move. It hasn't been Fed rhetoric. It hasn't really been the PCE and the other inflation. It was that payroll number that sent this thing into the stratosphere. And I think if you get any kind of a pullback on jobs, I think that gives equities a little room.